Chalmers has been talking to the RBA, and Aussie interest rates are tipped to crash. What happens when shares get shaky? People get funny about shares. They pull their money out of shares and they put it into hard assets. And the biggest thing that's going to happen to you, you're going to pay tax until you retire. Losing money on real life to get tax deductions is a loser's game. And what it costs you to build a house today, in 2 years' time, it'll cost you more.
70% of investors are not maximising this deduction properly. It's not, the average of the first year deductions out of all the properties we did last year was about $11,000 in the first year.
That money you're getting is less money than what you're getting today because money shrinks because of inflation. A lot of people don't get that. Let's say someone buys a $600,000 property that's brand new. What's the total depreciation you're going to get? How much tax savings? I'm curious about this.
There should be the best part of $400,000 worth of deductions in depreciation over the life of that property.
Okay, guys, me and my team are about to go live, so make sure you grab your beverage of choice, sit down, and you're in for an amazing show. Okay, hello and welcome. I'm here with Bradley Beer, the CEO of BMT Depreciation. Thank you for joining us, Bradley.
Great to be here, George.
Excellent. And before we start, I just want to catch everyone up on what's happening in the property market. You probably heard, Trump put all these tariffs in place, and the stock market crashed. And now, yesterday, he actually decided to pause them for 90 days. So stock market's sort of coming back. What's happening at the moment is, Chalmers has been talking to the RBA, and Aussie interest rates are tipped to crash. So what experts are saying that they're going to get a samurai sword and start chopping like crazy. The last time this happened was during the GFC, and we went down. So they expect now, prior to 2025, 5 interest rate cuts on the way through. So that's what's going to happen, maybe, which is good news for investors, because what happens when shares get shaky? People get funny about shares. They pull their money out of shares and they put it into hard assets. And what they're doing now is they're going to be moving from shares into property. Then you've got the immigration boom happening, which is putting more pressure on. And then with interest rates, we've got a perfect storm. So part of what we talk about is, one part is getting a property, and you've got to get the right property, but then you've got to get the right structure. And my favorite part, the most important part, because everyday Aussies that got 9-to-5 jobs or small business, they pay a lot of tax in Australia. The biggest thing that's going to happen to you, you're going to pay tax until you retire. And the rich, what they do is they lose money on paper and then make money in real life. And what the poor do is they try to get tax deductions by losing money. And you know what? Losing money on real life to get tax deductions is a loser's game. And Brad is going to talk to us about how the rich do it and how we can use this powerful thing called depreciation to actually lose money on paper, but make money in real life. Hey, Bradley.
Hey, George.
Yes.
Yeah, look, the big, and we'll get into this in more detail, but the really big thing about depreciation is what you're talking to there, it's a non-cash tax deduction. You get a deduction, you don't pay the money out, which is the best part.
Exactly. And that's what I love about it, because that's the one instrument that people can use to do what the rich do. And literally, with depreciation, you can actually get your tax dollars and convert them into property, which is pretty cool, which is awesome. And so I guess, how did you get involved in becoming the CEO of BMT? Because BMT is the biggest depreciation company in Australia.
Yeah.
Right? And all our members use you. I use you. Your company is very good at what they do. So how did you end up doing this?
So yeah, it's an interesting story. I went to university to do a construction management or a building degree, and part way through that, one of my lecturers, who was the original one of the founders of BMT, little small spare room company and he was one of my lecturers. So I went to get some work experience. I was the first staff member doing work experience back in showing my age here, but it was 1998. They'd been going for about 12 months. I went on and became a partner with those guys about 4 years later. The three of us ran the business together to where we are today. We've done nearly 1 million depreciation schedules. I sort of got worked out with we ended up those two original partners exited, got some other money invested from them, and then we bought the business back from the other money at a later date, about 3 years ago. And really, I suppose I was one of three that have run it from almost the start, and then really for about the last 15 years, I guess I was the managing director and then the CEO. So I've seen from the spare room, I've done just about everybody's job in there in some capacity.
So
It's been a fantastic journey. We've grown around the country. We've got over 200 staff, and we've done, as I say, nearly 1 million depreciation deals, and that's been our focus.
Yeah, and look, I mean, what you do is very good, but also what I like about is your standards and your higher deals, because we recommend BMT to all our clients, and the reason we do because you're the best. And how much do we get paid by you?
Nothing.
That's exactly right. Just let people know, because you don't pay anyone to recommend.
It was one thing that we decided against a long time ago, and we want to keep a clean relationship. And we do a lot of work for accountants. Let's keep this relationship clean. Accountants, we're not the guy that slipped in $50 to say we're the right guy. We're the people that have, time and time again produced the maximum result we can, and hopefully an exceptional service on the way, and learn how to do a good depreciation schedule and deliver one, so that they go, well, get another good one, and there's a place that delivers it well. I mean, it's not really that rocket sciencey.
Yeah, exactly. Now, so for the people joining us, what is depreciation?
So I think sometimes the easy thing to help explain it is to probably talk about a car, because then everybody understands depreciation, because you buy a new car, you drive it out of the shop, pretty much straight away it depreciates by, I don't know, 10%, does it? Or something.
Probably more than that, 20%.
Maybe more, and then you go back to trade it in 6 months' time or 12 months' time, and suddenly they say it's worth heaps less. So that's basically a depreciation in the value of the asset, or a decline in value over time. Now, if you use that car for business, then the tax office will allow you to make a deduction for your loss against that vehicle. And the same kind of concept works on investment properties. If you use a property for investment, then the things in there are wearing out, the carpet, the bricks and mortar, all that stuff is wearing out over time. And the tax office allows us to claim a depreciation, like your car, for the decline in value. The differing thing here is that we're buying property to appreciate in value. That's where people go, Brad, what? A little bit. But the overall value of the property we want to appreciate, obviously. That's what it's all about. But the carpet and the bricks and mortar are an asset that are like your 5-year-old carpet's not worth the same as new carpet. So it depreciates in value. It still provides an income. It goes up overall as a property. But the tax office allows us to claim a deduction for that wear and tear or decline in value of the things that are in that property over time. That's basically what it is. It's a pretty simple thing about the car, but on stuff that is going up in value, but the carpet's wearing out.
Yeah, exactly. And the thing is, normally you depreciate things that go down in value. And with houses, we got a bit of a hybrid there, because some of the things you depreciate are actually going up in value, which is exciting. Because bricks and mortar, for example, doesn't necessarily go down in value, but especially now, because building costs are going up, it's actually appreciating, because what it costs you to build a house today, in 2 years' time, it'll cost you more. Yeah. So to build it, which
the concept is it's still, the concept is it's still wearing out and one day becomes obsolete. So hence the rules are in place that way. No?
That's right. And I had a house in Adelaide, my original house that I bought, an old bluestone villa, and that was over 100 years old. And the way they built them in those days, it was still fine. You know what I mean? But so doesn't the accountant look after depreciation? Why do we use you?
It's always the one of the first questions, and the reason that we get involved is people say, I've got a good accountant. We work alongside the accountant, and the reason we do is I'm not an accountant. I'm a quantity surveyor. A quantity surveyor traditionally is someone who We'll be able to, get a set of plans for a building and be able to measure it up, count the bricks, count the steel, count the stuff in there, and actually be able to estimate what it would cost to build it. So we don't actually build it, but we pull the components apart and go, well, if we buy the bricks and get a bricklayer and get the concrete and all that stuff, if we're to build this building, what would it cost? Now, the reason that we do it as opposed to an accountant is that the depreciation claims that you make have a relationship to the construction cost and the value of the items.
Yep.
And the tax office says the accountants know how to do all of your accounts and things, but the person that knows about construction costs is a quantity surveyor. That's what they do. They count bricks. So they will, the rules around what the cost is based on is we do it based on the actual costs or the costs estimated by a relevant professional such as a quantity surveyor. So the compliance piece is the first bit. So with the tax office knowing there's compliance around the construction cost, but the second piece is around knowing the actual exact rules on what we can and can't do. We visit the property as part of the process. We go through, we find everything to help get the most deduction we can out of this property, and then we work to do something that's one of the things the accountant uses in your tax return. It's a bit like, I think the closest analogy I'd probably use is, it's a bit like you go to your GP when you've got some sort of problem, and if your ear's got a real problem, they send you to an ear specialist. And we're like the ear specialist, I suppose.
Yeah, for property.
He generally knows that it's there, but then he gets the real specialist to deal with whatever's going on in your ear, I suppose.
Yep. So, what you're saying is it only quantity surveyors that can legally give you a depreciation schedule?
It's not quite only legally. You can use some of the actual cost information that's there. So there's the combination of, well, what's the cost based on? If you've got the cost, you don't need me to estimate it. But then there's the second part of how do we maximize it, and that's pulling apart a bunch of things that are in there that are not provided with. It cost me $400,000 to build this house. Well, how much was this? How much was that? How much of these things that we can claim at different, faster rates, and we pull it apart. We do what we can with all the rules to make sure we maximize that deduction, because every dollar we claim's, some of that money back in your pocket.
Okay. So what you're saying is basically, as a quantity surveyor, because you experience it doing this, you know the rules, you can maximize what it is a lot better than someone that didn't know your expertise, because you know what you can and can't claim. But also, if you claim the wrong things, you can get in trouble with the tax department as well.
Good. You get audited and you're claiming a bunch of things and they know what it's based on. You see, that's not, and yes, you could get in trouble, but George, it usually goes the other way. People are doing a tax return and they're not claiming what they can.
Yep.
The thing is, if you do it properly, you get the most out of it. It's kind of like, oh, I listened to this tonight and I realized I maybe wasn't doing it properly. Then we fix it up and you go, oh, well, that wasn't great. I didn't claim last year. We can kind of go fix it a little bit, and we can tell you what you should have claimed, and you can fix it up. Most of the time, if they don't know, or they try to cut a corner somewhere and do whatever with whatever information they do have, they'll actually just end up claiming less than they can, and then that just means they're getting less money in their pocket throughout the course of the year by owning this investment property that should have the depreciation claim property. We did some comparison research, and it was a little while ago now, and it showed up then about 80%. I'd say it's better now, so let's call it 70% of investors are not maximising this deduction properly. It's not they're not claiming something, they're not claiming as much as they can.
Yep.
You should get it all. I don't know. I don't think they spend it that well in Canberra.
Yeah, look, absolutely. I mean, Bradley, look, we're all about maximising every part of the equation to get people the best and strongest investment. And that's why, I get everyone to do a depreciation schedule. And that's part of our strategy. And what I want to talk to you about is, there's new properties. You can buy properties that aren't new. And what's the difference there?
Yeah, so great question. And it's something that, we talk on a regular basis. We do both new and old properties. There is no, there's no, you can't claim it on old properties, but you just don't get as much. The simple fact is that, and I might go maybe a bit of detail as to why that happens. And there is, especially now, since some legislation changes in 2017, there's actually, there was always a difference, So new property would get more, but now there's a bigger difference since
Yeah,
2000.
2017 was a big shock. Absolutely. It was
Yes.
huge.
Anything that's been bought after, anything that's, so since 2017, anything that's new actually has a big jump in the difference of the claim. Now, there's sort of two reasons behind this. Now, the first reason of why a new property gets more is that it's new, it's shiny, it costs more. Like it costs more to build a property today, like we were just saying before, George. The construction costs have gone up substantially. So anything that you buy new or build at the moment costs more than the same thing did 5 years ago or 2 years ago even. So depreciation has a relationship to construction cost and the value of things. So when we go and look at it and go, well, you get a sort of a percentage of the value as a deduction each year. So if it's a high value, more deductions, basically. So newer, cost more deductions. Really, really quite simple. Has always been the case.
But 2017, didn't they stop you from claiming what fixtures and fittings?
Yes. So point one is new property costs more deductions. Point two, now since 2017, what they did in their infinite wisdom, we'll call it, with a bit of sarcasm, is said that we're not sure about this, the way some people are claiming, and they've got it a bit wrong, right? At the end of the day, we'll take my opinions aside. But what they did is they said that as soon as what's called a plant and equipment item, which is part of what the claims are, which is things like things that don't last as long as, like the building they put a life of 40 years on. I know 100 years, yours are still going there, George, but they sort of you get to claim the bricks, you want to call it, over 40 years in the structure. A lot of other things like, and there's about 170 different things in a residential property: carpet, blinds, curtains, lighting, air conditioning systems, stoves, kind of the things that don't last as long. You get to claim them quicker because, you know what, carpet doesn't last as long as bricks, so you get to claim it quicker. The stove breaks down after, well, the tax office says 12 years as its life, hot water service, all those things. So how we maximise the deductions is we find as many of those things as we can because we get to claim them quicker than we get to claim the structure of the building. So we find as many of those things, we put a value on them. Methods we come up with values is how we get, you know, the most deductions out of properties. Since 2017, if you buy a property that's got those things in it that's been previously used, as in secondhand, you don't get to claim anything against those things, against the carpet.
It's crazy.
So 12 months old, 10 years old, no claim against them. So all of this stuff, which is quite a substantial amount of value that gets claimed over 12 years and 10 years instead of 40 years, in a new property, you get to claim it. Or if you put it in there yourself, you get to claim it. If it's secondhand, you get nothing against it. Now, you know, so the new property, you know, for all the reasons that we buy whatever property we buy, new property, you know, this being a pretty important part of the tax deduction or the cash flow piece of the property, new property gets the most. There's no question, and there's the sort of the two reasons that happens. You know, the average of the first year deductions out of all the properties we did last year was about $11,000 in the first year. It's about 15 on new properties, average first.
Yep. And the thing is, the important part of this equation is the hardest part owning a property is when you first buy it, because that's when it's the most negative. Once you've had a bit of growth, like after a few years, then you're out of the woodwork, you're out of the forest, and you can start actually making more money. And that powerful depreciation for the first 10 years, what it does, it sort of helps cash flow the property until it becomes positive. Because after about 4 or 5 years, it's quite positive anyway, and it doesn't matter as much. But those first 5 years are very important when it comes to depreciation.
And this is where you get the most of it in those early years. It makes, because that's the time when you've just bought it. You'd hope in 5 years that your rents have increased, maybe especially, and interest rates do and change what they do. What your debt level is, who knows? But then if you look at, you know, hopefully some value growth over that 5 years, the rental increase over that 5 years, your loan or your depreciation is the most in those early years, and goes back to hopefully help cash flow some of that expensive costs at the upfront when you do buy that property and help you to get ahead, because you want to get to a point where some positive income comes out of the property, right, George? And this is a way that helps you to do that with some of the taxman's funds.
Yep. Now, there's two different ways you can claim depreciation, isn't it? There's diminishing and there's the other way. How does that work?
Yeah, this works with the plant component only. The building itself goes on that prime cost method. Diminishing is something that gives it to you faster at the start and at a higher, basically because of higher rates. Prime cost, I'll explain first, which is the second method, is the sort of the simple, it's a straight line amount. You get the same amount each year, the same percentage each year until it runs out. So if the things last 10 years, you basically get 10% each year of the value until you claim the whole lot of the value of whatever it is.
Mm-hmm.
Diminishing value, what you do is in the first year, rather than 10%, you actually get 20%. So you get twice the rate of deduction in that first year. And in the second year, rather than getting a flat amount, you get 20% of whatever value's left. So if it was, a $10,000 thing, 20% in the first year's at $2,000, and then the next year you'll get 20% of $8,000, which is the remaining value for that item, basically. So it's based on a higher percentage and always claimed on what's left. So it kind of never runs out. Basically, it keeps going on.
But it keeps getting smaller, and near the end, it's next to nothing. And you could probably guess which one I prefer. Right? I definitely prefer diminishing because it's the first 3 years, 4 years where you want to get as maximum deduction as you can to help your cash flow. Because once you're up on your feet, it's not that important.
Look, I agree. The only times we see someone use prime cost, and we do see it now, in saying that, we don't usually see it. We provide both. I don't know why we provide prime cost sometimes. It's a million reports I've wasted. Well, we don't print them anymore, that we wasted a lot of printing on for how many we used to print. But sometimes when there'll be a case with a property trust where they want straight line returns that they can explain, I guess. Because that reason sometimes they do it that way. Or if you know that in the first 2 years you're going to have a really low income, or the first 5 years low income because of your tax bracket or something, you're getting a big pay rise in 5 years' time, you might use it then. But who knows that much information about what they're doing?
Yeah, the thing is, your rent's gone up so much anyway. You're not going to get as much tax deduction because all it's going to do is balance off all the extra money you make. That's the other thing.
Yeah, I don't think I've ever used prime cost, and I don't think I'm about to start.
Yeah, so look,
more money today.
Yeah, so what we normally do, we obviously get brand new because we want to maximize our tax deduction, but then we do diminishing return. And then on top of that, what we do is we get an ITWV, right? Internal tax withholding variation. So we get the money every week.
Yeah.
And
yeah, sorry.
No, you go.
And so, yeah, we do that schedule to tell you what that number is. So you get your employer, the clients will get their employer to take less money out of their income every week. So you get to use it. You get to play with it before the end of the year and do a tax return, put it into offsets, save some money with it, time value of money. Money today is heaps better than tomorrow or next year.
That's the thing, because a lot of people are like, oh, I want to wait till the end of the year to get my tax return. And you go, no, you don't, because your money's actually shrunk by the time you get it back. So if you wait till the end of the year to get your tax deduction back, that money you're getting is less money than what you're getting today because money shrinks because of inflation. A lot of people don't get that. And money today is worth a lot more money than tomorrow.
It is. Completely agree. Always get it now if you can. And there's the time value of money, and there's also, if I get the money now, I can put it in an offset account and save myself some interest or whatever. So it's not just it's the time value, but it's also I get to use it. And
it's making you money, yeah. Exactly.
It saves me money.
That's right, exactly. And that's very important to be able to use it now because it's all about cash flow. See, a lot of people say cash is king, but cash flow is even bigger and better. And that's how we get the cash flow, because it's that magic thing between depreciation and your ITWV that's very powerful. And this is one of the cornerstones of the whole project of how it works.
Yeah, that variation is we do talk about that sometimes. It's not that's the accountant of the world's domain, and we recommend to your clients. We produced a report that allows them to do it. We don't do the tax returns or manage the cash flow.
Yep. So on the top of your head, let's say someone buys a $600,000 property that's brand new. How much could they get? Or what's the total depreciation you're going to get? How much tax savings? I'm curious about this.
It will depend on the property, but something that they buy for $600,000 will have a bit of a land component, etc. But it should be the best part of $400,000 worth of deductions in depreciation over the life of that property. And I'd expect, something like that, I'd expect, $15,000 in the first year would be an expected amount of deductions. And that'll stay at sort of 15, if I use that number, 15, 14 and a half, 14 something, 14, 13, whatever. And it'll eventually drop down to a point where over a 40-year period, you'll get that full, $400,000.
Yeah, that's amazing. So 400,000 over 40 years.
Yeah, you could expect to get that. Depends on. I mean, if it's a $600,000 one-bedroom unit that has a great view, you're paying for views and things, and not much construction. But it does relate pretty heavily to how much of that is part of the construction costs of the.
Obviously, because you've got a house and land, then you've got townhouse, you've got unit, and there's a different component of land component to those things as well.
Yes.
Yeah.
More
depreciation on a townhouse than a house, correct?
What was that, sorry?
More depreciation on a townhouse than a house, because
well, when you buy a townhouse, and sometimes it depends, but usually when you buy a townhouse, what you're buying is a bit more construction because you're getting less land.
Yes.
So then you've probably got a bit more of a construction cost relative to purchase price. It doesn't always work like that, but it usually does work a little like that. And in some of those places, you've also got some common areas, like you'll own part of the driveway. You get to claim your part of that driveway and things as well. So, but yeah, townhouse, you get a little bit more. Not a massive difference, but you'll get a bit more usually.
Yep. So what's involved in preparing a property depreciation schedule?
Look, it should be a pretty simple process. we talk to the client about the property. We want to make sure it's worthwhile to do it. Like old property still gets some deductions. So if it's an older property, we're going to ask a few questions, make sure there's enough money in there to bother doing it. With all of your stuff, a lot of the stuff you're working with here, George, it's new. There's never any question as to whether it's worth it because there's lots of deductions. We just talk them through that. We collect a bit of information. We've got access to the data houses to find out what information we can, a bit more information otherwise. And from there, then we go out and we inspect the property. We want to have a look at what it is, and we want to go and make sure we can find absolutely everything that we can that's a plant item. We want to make sure that we have a look at the construction and put whatever estimate that's as high as we can, obviously legitimately fairly put on it as a construction cost to help maximise that deduction. I think that inspection we see is an important part to make sure we want to find everything and make sure we get everything out of that. So one of our guys or girls comes out, inspects the property. From there, we just take the information we've got, come back, do the estimates, prepare the report, provide it to you and to your accountant, and take it off, go get some money from the tax office, basically.
Yeah.
So we try to make it a fairly a simplistic process. Talk you through it, what we need to do. It's all pretty digital these days as far as collection of information and things like that. Make sure we get some money back for them.
Yeah, it's fascinating because I've tried different depreciation companies in the same property, and they've all come up with different amounts.
And the thing is, estimating is not an exact science. Like many things, it's just like, I don't know, if you and I went to go and buy a washing machine, and we went off to two places and bought a washing machine, and we could buy the same one and pay a different amount of money. And that effectively is why you can get two numbers. We try to make sure we've got the best numbers, always.
That's Bradley. That's why we use you, because
yes.
we want the best numbers. That's what I want. I want every nook and cranny. I want you to count everything in there and get me maximum tax deduction, diminishing return.
I'm not searching for the cheapest carpet.
Yeah, exactly.
And so, there's a part that is it's not an exact science, because we might, just like we can go to buy two washing machines and someone might be a better negotiator than the other one. That's where the inexact science comes in when you're estimating, because you could have bought your bricks from here or from there and paid another $2 a brick, and it makes a difference. The other thing where I think there'll be a difference is you've just got to, like with anything, go learn how to do it properly before you do it, and be thorough. We go to site so we can find everything. We're not scared of the line. We're going to put it on it and get the most we can out of it. But then you get audited, and the tax office asks me questions. I go, would you like the photos, or would you like to know the time of day my Corolla pulled up that front for 30 minutes? I've
Okay,
got
so you keep all your records, do you, on all the properties?
all that. The cars are GPS. We can tell you how long they stopped there, and we've got the photos. We've got everything. By the time the tax office asks a question about an audited client, they're asking with about 1/50th the information we have because we've been there on a date, assessed it. They know next to nothing. We know everything because we've been out there. We got it. And we also, with all due respect to the department that asked the questions, they usually know a bit less about the whole thing than I think we do. So the questions are usually quite generic and easy to answer.
Yeah, exactly. Some pencil pusher in an office somewhere asking.
No, we better check this one out. Ring up the guys on that report. And we have had actually the department asked us a few questions that does that. And one time recently, they said that we actually had someone hit a wrong number on a report and they actually found a mistake in it. So they're like, this is so unusual. Like 7 out of the 10 of the reports we see here are yours, and we pretty much tick and flick them because they're so right all the time. And I also, thinking of that, I felt like I had success a little while ago when we always ask, how'd you hear about us? When someone calls up and orders one, and they said the tax office. I'm like, oh, that's good. Tax office called you and get an appreciation tender. They're probably not allowed to do that, actually.
Oh, really? That's hilarious. Funny enough, we've got a few members that actually work for the tax department, and part of the reason they joined our group is for tax deductions because they know this is the way to do it. So that's interesting that you say that, which is fascinating.
Yeah. So we want to make sure we want to back everything we do. We've done so many of them. We get questions, we answer them. They want to make sure that whatever we do gets as much as it can without getting anybody in trouble, including us. If we were doing wrong, we'd get lots of, we'd have them getting struck out all the time. We're not. They ask questions, usually because they don't know what they're doing. And we answer them. And we back the reports we do. If someone is going through an audit. Lots of our clients get audited. If I come back to an earlier point, often they call us because they're getting, say, people are doing what they're doing. They call us because they're actually getting audited. They legitimize whatever claim they have been making. Most of the time when we do that, the claims that we find them are more than they were claiming anyway, so there's no problem. We don't want tax office problems, not anyone else, but we want to get the maximum out of it we can.
Yeah, absolutely. Yeah, so it's like the government has allowed investors to use property like a business because, you can depreciate, which is what businesses do, their plant and equipment, and you can offset that about your tax. So it's really good. So really owning a property is like owning a little mini business, which is pretty cool.
And I think it should, property investors have been beaten around a bit by everyone at the moment or over the last little while. And I think we are like we're mum and dad investors that are basically the small businesses trying to make a couple of dollars out of and not live in retirement off a pension, etc. Like there's some is a bit different about a few more, George, I guess. But at the end of the day, it's planning for the future, planning for retirement, and also providing some housing. So I know they did back off them a little bit. There's a rental crisis partly produced by the fact that there's less rental properties because they keep beating them around.
Look, the way I see it, property investors are the only people that can solve the rental crisis. So since Albo had his target for the amount of properties he needs, what they wanted to build, they've been under target every single month since he announced the target. Not even close. They're never going to get there, even with everything happening, because what's happening is the government's spending a lot of money on infrastructure at the moment. So that's taking all the trades into government jobs, less people in construction. More construction companies have gone broke over the last 5 years than in history. Construction costs have gone up. It's the next 10 years, we're going to have severe shortage of property. So one thing, whenever there's a crisis, there's opportunity. So the next 10 years is going to be the biggest opportunity for investors in Australian history. More property millionaires will be made out of property in the next 10 years than the last 100 years, which is pretty exciting.
Interesting statement to see how that plays out. I think if they want to deliver the numbers, they need to incentivize in some way investors to invest in that stuff. I think
Yeah.
just for my 2 cents.
I don't know if you heard
And
what Adam, what's his name? The guy from the Green, Adam something.
Grant.
Adam Brandt, the
So,
latte sipping Ponzi that he is. Right.
we're not going to get political here, are we, George? But
Look,
I
he's
don't see
actually
how attacking and there's a big attack on the investors, and that all the rich people are only taking all these tax deductions. 80% of property owners that provide this housing own one. Look, it's not all a bunch of moguls getting all of the
no.
deductions. Now, those on higher tax breaks take a bit more of it, but they also take risk and get debt to
Yeah,
do it.
but he's actually now advocating to get rid of the capital gains tax exemption on properties and to get rid of negative gearing. Now, the thing is, he's trying to help people get housing, but he's doing the opposite. And this is what I suggest he should do. He should probably move to North Korea or Venezuela if he likes being a communist this much, because that's probably where he belongs.
Oh dear, we could go earlier anyway.
I had to have my little rant. Couldn't help it.
That's okay.
Now, I just, after I saw what he did, he was really made me annoyed. I'm going to go through our questions now. We're going to go through Q&A. Okay. RBA governor potentially making statement tomorrow on a 0.5% cut immediately. There you go. Interesting. Look, I think if they're going to do a cut, they're going to do it on the first Tuesday of the month like they normally do, but we'll see what happens. At what age of a property does the depreciation finish?
Good question, George. The depreciation finishes basically 40 years from when you build it. So if it's new property, you've got 40 years deductions. If it's a 20-year-old property, you've got 20 years left, basically. Now, in order to actually claim that the deduction against the structure, it all needs to be built after 1987. So in 2 years' time, basically, so if it's built in 1985 or 1984, you don't get anything against that structure. Built in 1987, you've got 40 years of claims, meaning it's nearly out, runs out until 2027, if my maths is right. Yeah, it is. So you basically got 40 years of claims. New property, 40 years, 10-year-old property, 30 years left is probably the answer to that question.
Yep. Tristan, can you explain what items depreciate at different rates, timeframes?
Sure. So what happens is the tax office puts what they call an effective life on the item, so that they think that carpet should last about 10 years. So that's the life, and that's kind of how you kind of claim it over 10 years, leaving out the prime cost diminishing value for a moment, but it's kind of got a 10-year life. They think that a hot water service has a 12-year life. They think that a stove has a 12-year life. And they put all these lists of things out there and how long they believe they would last. We've actually put them all together on a little app, free app called Resi Rates. Yeah, Resi Rates. Resi Rates, where you can actually see them all. You can see the percentage they use and how many years they expect them to last. So they put a list of these things out. We go find them. We put a value on them, and then we apply the life that the tax office kind of gives them, and that's how the depreciation is calculated.
If you have renovated or updated carpet, paint, stove, can you claim an existing house?
If you renovate and do, so we didn't really touch renovations. If you renovate, what you're doing is you're putting more things into the property. So you're spending some money on the property. So what you spend on the property, and that goes for both structure and the plant equipment. So if you buy a new carpet yourself in an old house, you can claim the depreciation against that new carpet. You put a new kitchen in, you claim against that new kitchen, not an instant claim, but you claim it over its life. So if you do anything that you do spend, you do get that claim against that plant equipment. Usually with new property, you shouldn't be spending too much, I'd hope, except maybe furniture.
Exactly. You don't really spend a lot on new properties anyway. But what I suggest you do is you're much better using money for repairs and maintenance than replacing things, because repairs and maintenance, you can actually claim that in the same year that you do it in.
Yes, that's R&M is something that as soon as you spend it, you get to an instant deduction for that. So it can be repairs and maintenance. It's better than depreciating it. So we just sort of separate out the things that R&M or repairs and maintenance, sorry, and then you claim over time the other things.
Yep, yep. So, okay, let's diminishing for sure. Hey, George, the next RBA meeting is until 20th of May, so not the first Tuesday in May, hence the potential cut now. Oh, there you go. There you go.
I did see there was some calls yesterday in the media, and apparently they can call a special meeting if they see it. Well, enough. Sorry, there's an ambulance driving past. And they
Well, there
can
you
call a
go.
special meeting and do it.
Well, there you go. Because I thought they just only meet on the first Tuesday, but obviously it's different. The thing is, if they drop interest rates, last time they dropped interest rates, which was recently, property prices went up straight away, like within a couple of days. And this is going to happen again. And then there's going to be another drop and another drop. So we've got potentially another 5 drops. And what I love about what I love about is low interest rates. It's cheap money and allows you to build your portfolio quicker and better. I always prefer low interest rates than high interest rates. That's just me, you know.
Oh, I've got properties in debt, so low interest rates are kind of handy.
Yeah, they're very handy, but they stimulate the market. Funny enough, during COVID, some countries in Northern Europe actually had negative interest rates, where you could borrow money from the bank and get paid to borrow money because they wanted to get people
Stimulate.
spending. Yeah, stimulate. Now, that's the sort of interest rates I want, negative. I mean, that'd be great.
I know. When that was all happening, I was like, "Can I borrow some money over there and bring it back over here?"
Yeah, look, I've always played with that idea because usually we got high interest rates, and you could probably imagine borrowing money in America and then buying property in Australia. The challenge is you got currency, and the Australian dollar, like it dropped recently, even if you've got a cheaper interest rate, it actually makes the interest rate higher anyway because you've got to convert the dollars into American dollars. So the currency fluctuations can affect you.
And I'm pretty sure that there's some banks in the world that are a bit more sophisticated with that idea than you and I, George.
Yeah. So, well, the thing is, what happens is they've got a low interest rate, but if you borrow money, then you need to hedge against the currency fluctuation, and therefore you're paying a high interest rate anyway. Yeah. So it all sort of makes sense because it's a world market, and that's the way it works. Okay. If you did not get max depreciation in year 1 or year 2 on a new property, can you claim extra in future years to catch up?
Great question. What you can do is rather than claiming the future years, you can like a bit like if you don't actually pay your tax, the tax office will come and find you and make you pay it, right? At some
Yep.
point.
Yep.
If you don't claim deductions, depreciation included, when you could have, you can go back and amend up to 2 years of tax returns pretty easily. Your accountant will help you do that and go, even if you've been claiming some and there was more there, like you did something, I'm claiming 10 and 10,000, you could have been claiming 15,000, then you can actually go back to 2 tax returns pretty easily and make sure you get that deduction for those previous years, adjust the tax return, and they'll pay you back just like when you do a tax return. Should have done it in the first place would be the good thing to do. You should be leaving the money at the tax office instead of using it yourself, but at least you can go back and it's 2 tax returns. And as we come up to another tax year, don't do another one before you fix it because it's one you'll miss out back in the previous years if that's the case. But yeah, 2 years pretty easy.
Yeah. I think the special RBA meeting was called due to the USA tariffs, as the Fed Reserve has also called a special out of schedule meeting this week. There you go. That's why we're having the RBA meet. Look, Trump has certainly shaken everything, and then now he's just sort of said, I was joking. Let's pause the tariffs. It's fascinating. I really think next 4 years we're in for a wild ride. And I think if you're in crypto or stock market, hold on to your hat because there's going to be lots of highs and lots of lows all over the place because it's going to be up and down.
It is amazing how one president can make a few. I'm sure he's not the only one involved in making that decision that does that, and globally makes such a schmozzle of share markets and the amount of billions of dollars have been
Trillions, no,
pulled out of those in the last few
there's
days.
been,
And then he said something else yesterday, and it all jumps again a little bit today. It's
well, I think all his
mind-boggling.
billionaire mates weren't very happy because Elon Musk said that the guy who was consulting Trump on the tariffs is dumb as a sack of rocks. That's what he said.
That was his words.
That's his word. Thumbs a stack of rocks. So, and Elon Musk's a pretty smart guy.
Yeah.
And, you know, so after that, I think maybe he rang Trump because apparently Elon's the real president. Anyway, he rang Trump and said, mate, stop those tariffs. My Tesla stock's gone down. People,
And,
you know, stop buying it. He's lost so much money.
and I think like it's one thing. Like I've been a property investor since I don't know. I've been a BMT for nearly 28 years, and I don't know when that is 90. I think I bought my first property in 2001, late 2001, 2002, and I've bought a numbers of properties since then. I'm a holder. I have had some money. I've got have money in the share market. You know, they tell you to diversify, etc. The beauty with the properties is is I've held them over time. They've grown over time. They go up, they go down a little bit sometimes, but generally have gone up over that time. And the ability to debt and leverage in those is what is the thing that you can do that makes the stand the test of time. And if we have a bit of a crash in property values, as long as I pay my interest, no one comes and asks me for some of the money back.
Exactly.
What the problem is with the problem with the stock market.
No. Look, a friend of mine lost 200 grand the other day when the tariffs were announced, right? And nothing happened to my properties. And I think, you know, I'm glad to have hard assets because that's the thing. I mean, shares are soft assets and so is crypto, but property's hard asset, and hard assets are always going to stand the test of time. And you can make money in the share market, but you can also lose a lot of money. And I'm not into losing, I'm more into making. And I prefer my investments to be very boring. But next 4 years, if you're in shares, it's going to be very exciting. You're going to wake up one day, be very happy. Next day, you're going to be sad, and it's going to keep going. But I've got another question.
It gets valued every day is the other problem. The other issue you've got. It gets valued instantly all day in the share market, doesn't it?
Yeah. Well, the thing is, you can actually stop believing in a company, and if everyone stops believing in it, it'll crash to nothing. And so is crypto. You forget, you know, sometimes the crypto, some people stop believing it and crash. But even if you can't stop believing in property because it's a real object that you need to live in. You can not
you
believe
don't live there anymore. Someone else probably needs to, especially in the current world.
Exactly.
With the rental prices.
That's right. So John said, with an existing property purchase 3 years ago, we did not set up an ITWV. Can we do this now?
So that'll be a question that would probably need to end up at your accountant. You can't probably do it for the past. You do your tax returns, but you can. I think as far as I understand, George, you can do one of those anytime. So there's some years you might not need it.
You can, but only if you've got a depreciation schedule. You need if you've got a depreciation schedule, yes. So it depends on how old the house is, and if you've got a depreciation schedule, yeah, you can do it anytime. It doesn't matter.
Yeah, I'll probably new property, whichever one. That it doesn't. Setting up that form's not related to how much depreciation there is. That's just one of the numbers that goes in there. It subtracts the other expenses from your property, the interest, etc. When it calculates what the tax should be that your employer takes out, it would be adjusted based on all of the inputs and outputs.
Exactly. And now we're going to cut the live stream. We're going to go into our private group, and this is where we answer more questions.